Okay, so tonight is business combinations, right? So you should, Anna sent you the slides by email, and this is one of those classes where you might want to follow the slides pretty closely. And like I was saying, the way that we're going to cover the material tonight is largely me just talking about it, and then when I see that you get sleepy, we'll do a problem or take a break. Believe it or not, I actually drank the Red Bull on the way here, so Mike, you can't even win a Red Bull tonight. Although I think I have one more in my car. Okay, so the way that we're going to cover business combinations is really by way of covering this process. Okay? And I'm not going to bore you with the material here, we'll just go through it. So the first thing that you're going to want to do when you deal with the tax accounting for a business combination is understand what the combination is, what the transaction is. Because it's pretty hard to account for something before you know what the tax effects of that thing are, right? So with M&A or transactions, we got to stop and think, all right, what's happening, right? Do we owe tax? Are we saving tax? Is there tax exposures? We need to know what happens before we can worry about how to do the debits and credits, right? And the problems that we've dealt with so far in class, you've largely just been given the answers, or the assumptions rather, and you just needed to go do the debits and credits around it. But tonight, as we talk about acquisitions, you need to understand, well, what kind of acquisition is it? What are the tax consequences? And then from those consequences will come the accounting. Okay? And you know, there is not one type of acquisition. Okay? And I know this will be a little more difficult for you students who don't have work experience than the ones that have seen deals, but know that not every acquisition is like another. Okay? And so you first need to understand what kind of acquisition are we talking about. So in general, when we buy a company, okay, so say we're parent and we're buying subsidiary. When we buy subsidiary, we need to account for all of subsidiary's deferred taxes when we inherit them, right? Because if you think of two moments in time, like the first moment being it's just us, it's just parent. Subsidiary doesn't exist. So we don't have anything for subsidiary. We don't have any deferred assets for their NOLs. We don't have any deferred taxes for depreciation. We don't have any of that stuff on our books. And the moment after we acquire subsidiary, now for US GAAP purposes, we're probably filing consolidated financial statements, right? And so when you look at the 10K for a company, you know, the 10K for a company is going to capture everything, right? And so if there are deferred taxes at this level, whether it's NOLs, depreciation, whatever, those deferred taxes now need to be recognized and reported in the consolidated financials, right? So in those two moments in time, the moment before the acquisition, these things don't exist, and then all of a sudden, boom, we have deferred taxes, okay? And those deferred taxes didn't come to be because of the way that we created deferred taxes in the past, right? Meaning in our examples before, the way we got a deferred asset was we added back an expense, right? So take like bad debt reserve. In our examples in the classes so far, we added back book expense, that created a deferred asset. Here, there's no expense to add back. When we buy this company, it might come with a bad debt reserve. So then it means it comes with a deferred tax asset. Right? So think of this as we're acquiring a company that already has history, and their history suddenly becomes us. Okay? So the way we're going to account for this transaction is to take our deferred taxes, everything that we have from a tax perspective, and then suddenly add someone else to the mix. Right? We have all their garbage now, right? Their assets, their liabilities, their exposures, whatever. Okay? So in general, the goal of accounting for a business combination is on the date that a deal closes and this business becomes part of us, we need to stick on our balance sheet all of their tax attributes. right? Whether those are a tax liability we owe a taxing authority, a deferred tax asset for an attribute, anything that you would think about as their provision becomes our provision. Okay?
So what if they're immaterial?
What if they're immaterial? Then it's really easy. You should have put that as an answer on the exam. This is immaterial. Okay. So we're going to talk about two types of transactions, okay? Taxable and non-taxable. Now, this is a source of great confusion, okay? And the reason is that when the accounting guidance refers to taxable and non-taxable, the difference is whether or not the assets of the business get a step up in value, okay? So when I sell to you, okay, so say that, I sell to Jenny, my company, and I sell her the stock of that company. Then the assets of my company have, continue to have their old historic tax basis, right? So if in my company is a truck that's worth $10 and has a basis of $4, when she buys my company for $10, the truck still has a basis of $4. Right? There's no inside basis step up. That transaction, for tax purposes, that's taxable to me. I sold stock for cash. I have a gain on the sale of my shares. I have a tax effect of that. But there's no inside basis step up. So that transaction is what books would call non-taxable. That's confusing because I just paid tax, right? So that sounds very taxable to me. But from a book perspective, they're referencing, do I start over with the basis of my assets or not? And in that example, the answer is not, right? So a stock acquisition, where inside the company I'm not changing the basis of the asset, that is a non-taxable transaction for this purpose. However, if I sold Jenny my assets, if I just said, look, instead of buying my shares, buy my truck, buy my other stuff that I have, buy my assets directly. That is what books would call a taxable transaction, okay? Because now the basis of the assets is going to restart at its fair value, okay? Okay, so when we say taxable and non-taxable, don't think of me, the seller, and whether I'm paying tax, because that's what a normal tax person would think. Think inside the company, is there an adjustment to basis because the transaction was taxable or non-taxable at the asset level. Okay? Okay, so in a second we're going to talk about why companies do taxable or non-taxable deals. But for now, if a transaction is taxable, this is like Jenny buying my assets, right? And if she paid $10 for my assets, for tax purposes, the way that works is I'm going to take that $10 and allocate it to the assets that she bought. And I do that based upon this chart here, this 1060 allocation chart, where I take the $10 that I paid and I go from top to bottom in this table and I allocate it to the fair value of my assets. Okay, so first I say, of that $10, how much is attributable to cash? Well, I don't have any cash. How much of that $10 is attributable to public stock? Well, I don't have any of that. Class 5 is kind of a catch-all, and that would be where a truck would go. And so if a truck was my only asset, I would allocate all of my purchase price to the truck. Okay? So some of you who have work experience, you might have seen this before, but this is simply a common sense. If you paid something for a pool of assets, how do you allocate that to the pool? Well, you do it based on the most liquid assets first. And if you still have purchase price after you ran out of all your assets that you bought, the rest must be goodwill. Okay? So that's how this chart works. Okay, so that is in a taxable asset transaction. You take what you paid and you allocate it to the assets that you got. And however you allocated it, that's your new tax basis in those assets. Okay? A non-taxable acquisition or non-taxable transactions. Okay, so these are stock acquisitions. And those stock acquisitions can either be Jenny buys my stock for cash, or sometimes, like in the transaction that you hopefully read in your homework, it's an acquisition where one company says, I want your stock, and in exchange, I'm going to give your shareholders my stock. Right? So when Lamb bought Novellus, Lamb said, okay, we want to acquire all the Novellus shares so that Novellus becomes a subsidiary of Lamb. And in exchange, those Novellus shareholders are just going to get Lamb stock. Right? So that's a stock for stock acquisition. So either way, books would call that a non-taxable transaction, even though if Jenny buys my stock for cash, that's taxable to me. And in the Novellus transaction, that was non-taxable to the Novellus shareholders because that was structured as a reorganization for tax purposes. So that is very confusing. So if you just got out of your corporate class, you would say the Novellus transaction was non-taxable or tax deferred, and you would call my transaction with Jenny taxable, but the accounting terminology is different. Okay? We good with that? Okay. So in a non-taxable transaction, the inside attributes of the company, meaning the tax basis of the assets, the NOLs, the credit carryovers, all those things stay. Right? The history of the subsidiary or the target stays intact. Whereas in a taxable asset transaction, it's like a big do-over, right? You start from scratch as if you just bought assets and then off you go. Okay? Okay, so if you're the buyer, right, you're going to ask basically two questions. You're going to understand, you need to know what the tax status of the target is. What kind of company are they? What's their structure? And you need to know what type of acquisition this is. Is this the kind where I'm inheriting a bunch of history, or is this the kind where I'm starting over from scratch because I get a fresh start, a fair value basis and everything? Okay, so if you step back and you think about M&A transactions, there's really four ways to structure a transaction. Right? As a buyer, you can buy assets of a company or you can buy the stock of that company. You can do it in a taxable way or you can do it in a non-taxable way. Okay? So this class is not meant to make you an expert on M&A, but it helps to understand a little bit about why M&A transactions get structured the way they do so that you can appreciate the accounting later. Okay? So if you had to guess why people structure a transaction as a taxable asset transaction, why do they do it that way? What do you think? Okay, so Timmy's thinking it's because the target has an NOL. But in that example, if target has an NOL and you buy assets, then the buyer doesn't get the NOL, right? So what does the buyer get? So that sounds bad for buyer, right? So buyer's going to be like, I want to buy the NOL. I don't want to buy the assets. Good on.
So you don't take on the liability.
Right, so not all this is tax, right? If you're a buyer and you look at the target and you're like, I don't know what kind of skeletons you have in the closet, people might want to sue you, and I want nothing to do with that. So instead of buying your legal company with all these unknown problems I'm unaware of, I'll just buy your assets, and then you keep your problems, right? Those will be your problem and not mine. Right, and so legal contingencies is a good reason that, in fact, one of my clients announced a deal today where this was a big part of the way that they structured their transaction. Okay, so there a buyer might say, I'm not buying your shares, I don't want your problems, I don't even know what your problems are, and I don't want to spend the time trying to figure it out. So I'm just going to buy the specific assets I want, and then the rest is yours. The rest might be a lot, it might be nothing, I don't know, I don't care. Right?
Are you saying if they purchase in unencumbered property, that they don't have to take on
No.
the debt with the property? You're not saying that, are you? For example, if they buy a car, and there's a loan on the car, don't they?
Yeah, if a company structures an asset deal, there will be an agreement, and in that agreement they'll spell out what they're buying and what they're not buying. Whereas when they buy a company, whatever's in that company, whether people know it or not, just got acquired. Okay. So what's the main tax reason that a buyer is going to want to buy assets?
Step on above the basis.
Right, it's a basis step up. So if a buyer, if Jenny buys my truck and then she pays $100, she gets a $100 basis in the truck, and now she amortizes or depreciates the truck. Right? So she's going to save $35 in tax in the future because she's going to depreciate her purchase price. Where if she pays $100 for my stock, and the truck has no basis, let's say, she doesn't get to depreciate the basis. Right? And so, all things being equal, she would say, I would prefer to buy the assets. That sounds better, more efficient from a tax perspective. Right? Okay, why else are we going to do an asset deal? I mean, these are honestly the two biggies. Is from a non-tax perspective, buyer limits their exposure on uncertain or unknown obligations, whether they be tax or non-tax, and buyer gets a basis step up. It gets to recover its purchase price for tax purposes. Right? Those are two biggies. Okay, so why does the seller not want to do an asset sale? Or why do we end up doing a lot of stock transactions? Because that sounds pretty good, right? What we just said there, buyer's happy. What's seller's problem?
They have a tax obligation.
Right, so if seller sells assets, I have double tax, right? So I want to avoid double tax. So if I sell Jenny my truck for $100 and that's my only asset, then I'm going to have a $100 gain at the corporate level and pay corporate level tax. And then when I distribute my proceeds back to me in liquidation of my company, I'm going to pay tax again. Right? So I'm going to look at that as a seller and be like, hey, I'm pretty happy with you being happy for this tax depreciation on your purchase price, but I'm not so happy for myself because what I ended up with at the end of the day, it's not so great for me. Right? So in that simple example, if I start with $100 of proceeds and I pay corporate level tax of $35, then in the liquidating distribution, I'm going to receive $65 as the shareholder of this company, and I'm going to pay 20% tax on that, right? So that's another $13. So I'm only left with $52, and that's before Jerry Brown gets his cut. Right? Which hopefully is not bigger tomorrow than it was yesterday. So this is not good. I'm only getting $52 out of my 100 proceeds. I'm going to say, hey buyer, this is not good for me. I want to go back and sell stock, because if I sold stock for $100, and I assume my capital gains rate is 20, I get to keep $80. So I'm going to say to buyer, I want to receive $80 after tax, right? Which means if they want an asset purchase, they better take this number and make it a whole lot bigger so that at the end of the day, these numbers become equal. So I'll say to buyer, hey, I'm happy to do an asset purchase if I'm, agnostic from a non-tax perspective, but the tax is just math. And the reality is, when you do the number crunching on this, it will never make sense for buyer to buy assets, given the tax mechanics. Because buyer is going to have to pay a whole bunch now to basically pay tax today just to save tax in the future. And it was never going to make any sense. So the fact that there is corporate level double tax means that you avoid that double tax by not triggering that corporate level gain. And so of these two categories, whether a deal is an asset deal or a stock deal, this is the vast majority of the transactions is a taxable stock deal. You see these all the time. Okay? And for companies that go through an M&A transaction and they have never done it before, it's always a frustrating, kind of eye-opening experience how you end up between these boxes. But once you get educated on how the mechanics of the tax treatment to both buyer and seller work, you'll find that the efficient tax answer will be to land in that upper right-hand box. But there's always an education session to make sure buyer understands why and seller understands why. And that there's exceptions in of course, to the general rule. So whether you end up in one box or another can just kind of depend on where the target stands, what seller's basis in target is, what the inside-outside basis difference is. It gets complicated, but the vast majority of the time, given a normal set of facts, people end up in the upper right-hand box. Okay. In this slide, when I say taxable or non-taxable, I really mean from a tax return perspective and not so much from an accounting perspective. And the big difference in terms of whether you end up in the top half of this chart or the bottom half of the chart is really a function of the consideration you use. So if the Novellus transaction were a share for share transaction, the consideration is equity. And in that case, the tax rules, Section 368, if you're careful, allows you to treat that exchange as a tax-deferred transaction. No one pays tax on it. Okay? If instead the Novellus transaction were cash consideration or non-equity consideration, you would end up in one of the top two buckets. Okay? And whether you're a reorganization, a 368 transaction or not, and again, this is a whole nother class in your MST program, whether you end up in the top or the bottom is more than just whether the consideration is cash or stock, but that is the biggest differentiator. And when you think of Lamb didn't have $3 billion of cash sitting around to buy Novellus, so they were motivated to use their shares as a currency, right, because that was an asset that they could use to buy Novellus. So they did that for non-tax reasons as well, but from a tax perspective, it was very efficient for them to use stock because the shareholders of Novellus would say, this is great, right? I realize some value in my shares, but I don't have to pay tax on it just yet. Okay? So whether you see a transaction as assets or stock here, this tends to be a lot more around non-tax considerations, and it has a lot more to do with what is the structure of the target. You know, are they a standalone company that you need to buy the equity of? Are they a division of a bigger company that you're just going to pick up some assets? The key is, what is the form of consideration? Okay. So I see a lot of M&A transactions at work, and if I had to put some numbers to these boxes in terms of where people fall out, I would say that probably 80% of transactions fall into this bucket, and that's where we'll spend most of our time tonight. Probably 10% in that bucket, and 10% in that bucket, and an immaterial amount there. It's our most colorful slides so far in class.
Does it matter if you're given a percentage of a company, like over 50%?
Does it matter if you're only buying a percentage of the company? I mean, it's a good question. In the class tonight, we're going to talk about business combination as one company buying 100% of another company. There are other cases where, of course, it's something less than that, and the accounting for that depends. It depends on how much you get, because if you have less than a 100% stake, it can be one of three things. You can still consolidate if you have a controlling interest. You can use equity accounting if you have a significant interest, or you can use cost accounting. Beyond the scope of tonight, but the answer is it depends on how much you buy. Okay, so that's M&A basics, but anytime you start with a business combination, you should start with, well, what kind of deal is it? What are we buying? What is the tax treatment of that transaction? And from this, the most basic thing you should walk away with is, did I acquire the history of this target? Meaning because I acquired anything in this box, that box, or that box will mean I acquired the history of a target. So I get its NOLs, I get its tax basis, I get its exposures from the past potentially, right? And anything from this category, and I say that one a little loosely, but anyone in this category, I kind of start from scratch. Whatever I pay, that's my basis in the assets. The history doesn't matter. It's a do-over. I'm starting, anew. So at a minimum, you need to know when you have a deal, what kind of deal is it? Where does it fit in this matrix? And then what happens to me now that I move on to the day after I acquired this company? Does their history matter or not? Okay? Questions?
On the stock part, isn't it better a bunch of changes in the stock, don't you move an NOL that created two things?
You can.
I see, most people are concerned about if you lose your NOLs because of too much of a change.
Yeah, well, that's a good question. We'll cover that. I'll try to sneak that in a little later in one of the examples. For now, know what kind of deal is it? How is that deal taxed? What do I care as the buyer? Because if I'm the seller, I'm not really worried about purchase accounting. I'm worried about finding the beach I want to just sit on, right? If I'm the buyer, right, and if I'm Don Scott, and I buy a company, which they do on a very regular basis, I need to figure out, okay, fine, now I got to account for these guys, right? What do they have? What do I need to stick on my schedule of deferreds, my tax liabilities? I need to just come up with an inventory of all the stuff they have that I need to know about and stick on my books. Okay, so that's step one. Figure out what kind of deal you have. Step two. So now we're going to deal with the tax consequences of the book accounting. Okay, so I'm going to explain this. This is one of those areas where I don't think words can ever get the concepts across. So we're just going to do some basic examples, and I'll show you how it works. Okay, so in this example, USP buys Target for $1,500. For book accounting purposes, and we're going to assume that this is a non-taxable transaction, I think. But forget tax for the moment, okay? Pretend you're the controller of a company, and you're worried about how I'm going to deal with book accounting. So I pay $1,500 for this company, and then what I do for accounting purposes is I go out and I try to figure out, well, what did I just buy? I know I bought legally a company, but inside that company are assets and liabilities. And from a book accounting perspective, I'm going to put the assets and liabilities of that company on my books, right? Because I'm going to consolidate with them, right? So there's no such thing as I just bought a company and all I own is a company. Now whatever they have, that's me too, right? It's like I'm adding two things together now. So whatever cash they had or trucks or intangibles, all those things are now part of me. So for book purposes, they're going to take their $1,500 and they're going to allocate it to the assets. And the way that they did that, at least in this example, is somebody in accounting decided that they would allocate the basis based on fair value, as it's shown here. Okay. And so in a second I'll show you what the book accounting journal entry is, but it's probably pretty self-evident from looking at this chart that they're going to book the assets as they've described them here, and an offsetting entry to equity. Okay, that's how they would set up their book balance sheet. Now, for tax purposes, we've listed the assumptions here next to the fair value column, and as you can see, the tax basis in the assets is quite a bit lower than the fair value. So if when Books acquires this company, when Parent acquires this company for book accounting, if they put a book value on PP&E of 200, but our tax basis in PP&E is only 150, then what do we do? What do we have? We have a DT 50-50. Lewis, what do you think? Do we have a DTA or a DTL?
He went this way, what someone said.
A DTL, right? So if we sold this asset for its book value of 200, and we only have 150 of tax basis, that would mean we have a tax gain, right? Which would mean we have a deferred tax liability. So that means, just with this simple example, we buy this company, book says the PP&E is worth 200. Well, if they're going to say that, then they've also got to say that they have a deferred tax liability of 50. And that doesn't mean that the target, before we bought them, had a deferred tax liability of 50. They might have had no deferred taxes. They might have had 0 book basis, 0 tax. But the way Books does its purchase accounting is it takes whatever we paid and it puts it to the assets on a fair value basis. And then all us tax guys do is compare that new book value to our old tax basis. Grant?
When you say your old tax basis, the old tax basis of the old company, of the company first books, or your old tax basis company? Somewhere in the language about a minute ago, you said something I'm trying to catch.
Right. So let's assume that the day before this acquisition, Target owned a truck,
Right.
which is this PP&E, and its basis in that truck was $150.
Good.
Nothing having to do with this transaction, because we bought the stock of this company, is changing that fact. Our basis for tax purposes is still 150.
So what you saw was like on the depreciation schedule, you saw 150 not depreciating yet.
Exactly.
And when you got the truck, you realized the truck's actually worth 200.
The book guy said is worth 200.
Exactly. The
Right.
market value of it's
Right. So the book guy said I paid 200 for it, just like I paid fair value for everything at this
now
company.
to the rest intangible goodwill.
Exactly. Right. And so based on whatever Books does, we might have deferred taxes that pop out, right? If book guys said, oh no, that truck's not worth 200, it's worth 100, our basis is still 150, and so now instead of inheriting a DTL, we inherited a DTA. So we're going to just find out, well, what do we know our tax basis is, and we're going to compare that to whatever the GAAP guys say. And whatever they say is going to be based on a whole exercise that they go through, right? But is not a tax exercise. Okay, so we kind of already bit off some of this, but essentially what we're going to do is a process step, and we start with the assumption that this is a taxable asset transaction. Okay, so we're going to bob around a little bit here. So if the assumption is that this is a taxable asset transaction, that means my basis in whatever I bought, it's whatever I paid. Okay, which is the exact opposite of what we just talked about, just to be clear. Okay, so if I paid $1,500 for these assets, then I'm going to allocate my tax basis usually the same way that Books does, because Books is trying to allocate based on fair value, and so is tax. Okay? So in a taxable asset transaction, because the allocation of my purchase price is the same for book and tax, there's really no difference that pops out. If I paid $1,500 and $200 is allocable to a truck, it's probably allocable $200 for book and for tax. And that's not always the case. Something funky can go on, but in a normal straightforward deal, this is how it will work. Okay, so in a taxable asset transaction, you don't have any deferred taxes. There's nothing to set up on day one because that book and tax basis, it's the same. And so when the accounting guys record their purchase price entry, it will look like this guy. So even though they buy a company, let's say, if they structure it as a taxable asset transaction, the journal entry that the buyer will put on their books will look just like that. Okay? So if you have a taxable asset transaction, usually those are easy. There's not much to do. Deals in real life can be more complicated than this, of course, and so you need to be careful. But in most cases, a taxable asset transaction is kind of a nothing because the book guys are allocating purchase price based on fair value, and so are the tax guys. And if there's no differences, there's usually nothing to do. And we're not acquiring history, so we're not getting NOLs, we're not getting tax credit carryovers. We're starting from scratch, and that's kind of how book accounting works. They kind of start from scratch too.
Can you do the due diligence? I mean, does everybody verify that is the tax basis on the first problem?
Well, we'll get to that in a second in terms of what happens if we do the same thing in a non-taxable transaction. But absolutely, if this is a transaction that's not a taxable asset transaction, the buyer's going to want to know what is the tax basis, what are the historical tax exposures, what are the NOLs I might get. I need to know what the history is I'm about to assume. Okay, so that's essentially this problem, right? So now we're assuming the same facts, but the transaction is a non-taxable stock purchase. Okay, so this is that box in the matrix that I said happens 80% of the time. Okay? You really have a question or not really?
Those two examples we just showed. So on example one where we had the tax basis which was less than the actual fair market value.
So that's what I'm going to show again right here.
Okay.
Okay, so this is confusing because we're mixing tax lingo with book lingo. Okay, and when I say something is for tax, okay, so I'm just a tax person. This is not an accounting class. Okay, so just assume tax. If I go to you and I say this tax transaction is non-taxable, that means I think it's a reorg. Okay, means it's tax-free to me as a seller. Whatever I'm selling in exchange for stock that you're giving me, that's tax-free to me. I'm not paying tax. Okay, that doesn't happen that often, but that's how the Lamb Novella structure was working. Okay? Back when Cisco was doing deals left, right, and center, that's how all their deals. They were like, here's my Cisco stock, give me your stock, right? Stock for stock. So as a tax person, I would call that non-taxable. From a taxable perspective, I would say from a tax person's point of view, this could be stock or assets where there's either seller or target gains. Okay? So if I sell you my stock for cash, if I sell you my asset for cash, as a tax person, I think that's a taxable transaction. Somebody is paying tax because this transaction was a realization of it. Okay? So that's how I would describe it if I was a tax person. If I'm a book type, right, now I'm an accounting person, I'm not a tax person. So if I'm doing the accounting and I think of taxable, non-taxable, from an accounting perspective, whether you call something taxable or non-taxable depends on what happens to the inside basis of the assets for tax purposes. If you're an accountant and you say taxable, that means that it's basically the equivalent of a taxable asset transaction from a tax person's perspective. Because that is the only type of a transaction where the asset basis for tax purposes is going to be refreshed. Everything else from an accounting person's point of view is what they call non-taxable, because the inside basis doesn't change. So on this slide, this is a long way of answering your question, but on this slide where it says non-taxable stock purchase, it doesn't mean it's because it's a reorg or it's tax-free to the selling shareholders. This is just using the book accounting lingo to say that there's no inside basis change in the assets for tax purposes. I know that's super confusing.
So in the previous slides, you listed that for Fox, that one is from the book accounting.
I don't think so. So when I list this is from a tax person's perspective. So when my client calls me and they say, I want to know how to do a deal, which is the type of deal I want to do, I'm not using book accounting lingo with them. To me, that's crazy. This chart makes sense, right? Is somebody paying tax or are they not paying tax? Is this deal going to be structured as an asset deal or as a stock deal, right? People can wrap their heads around that. The thing to me, and I guess I'm biased because I'm a tax person, is that the accounting lingo is confusing.
And then on your slide 6, for that taxable and non-taxable business combination, that one is, for this section 1060, this table is from the booking perspective.
Well, this one will be the same because this is both a taxable transaction from a book perspective and also from a tax perspective because this is a taxable asset sale. For now, just to get back to An's question, this transaction, when we say non-taxable stock purchase, this means I go out and buy An's company, I pay her cash, she gives me the shares, she pays tax on the sale of the shares, but nothing happens to the inside basis of the assets.
From a tax perspective, it's taxable.
It's taxable to you, but it's not taxable to the inside company. Nothing happens to the company. You as a shareholder or an investor in that company, you pay tax at the investor level, but there was no tax event at the company level.
So from a tax legal perspective, we would classify this as a taxable stock transaction.
I would, because you pay tax, right? If I told you that was non-taxable and you're starting to cut a check to the government, it's not feeling very non-taxable to you, right?
But from the entity, it's seller's standpoint, it's from the entity standpoint. In a non-taxable transaction, the entity does not pay tax. In a taxable transaction, the entity pays tax.
Right. So if you go to An and you say, An, it is a non-taxable transaction, and An says to you, yeah, but I'm cutting checks to the government, it's just very confusing, right? So what I would tell you is from a tax person's perspective, use common sense, right? Use what makes sense. If you were an advisor and your client is your client, right? How would you explain it to them? You're going to explain it to them from their perspective, not from the entity level perspective. But the way the book accounting works, it looks at the inside basis effects of the assets. Okay? Don't get too hung up on the terminology. Just know it's important to be slow and careful, and that not every acquisition is the same.
So pretty much if you're receiving stocks, no tax on everything. That was what I thought.
So I think Timmy's question is, if you're selling shares of a company and you get back equity in another company, there's pretty much no tax, was I think your words, right? And the answer is that's a good start. And you just need to make sure you satisfy the other requirements of a tax-free transaction, of which there are many. but that is the hardest one to overcome usually. Okay, so in this example, so now we have a taxable, sorry, a non-taxable stock purchase, right? And this is me buying On's company. She pays tax at the shareholder level, but nothing happens inside the company. Okay, this is not a taxable transaction involving the assets. So now the book guys are still going to take their $1,500 and they're going to allocate it to the assets acquired, right? Because they're going to say, hey, tax guys, you do whatever you got to do, but I paid $1,500. I'm allocating that to the assets I acquired. I hired some valuation firm to tell me how to allocate, and they came up with $200 to PP&E, $1,000 to intangibles, and the residual to goodwill. Okay, that's typical. Hire a firm, they tell you how to do it. Okay. So then the tax guys are going to roll in and say, okay, well, now that I know what you book guys are telling me the value of your assets are, now I got to compare that to my tax basis. And out will come deferred taxes. Okay? And so I'm going to take my PP&E and I'm going to say that if books is saying it's worth 200, but I've researched my tax basis and I know it's only 150, well, that means I have a taxable temporary difference of 50, which means I have a DTL of 20. So when I bought this company, for accounting purposes, I inherited a 20 deferred tax liability. And I need to know that, because if I sold the truck the next day and I picked up that $50 gain for tax purposes, if I didn't have that deferred liability sitting there waiting to cover that tax, that's going to be a problem, right? So we need those deferred tax liabilities, otherwise we have surprises later when we sell assets for book value. I mean, that's a problem. So the most...
So you're booking this all along with the purchase right away, or do you have to kind of flesh this out through provision?
We are, you'll see the punchline in a second. Okay, so far, you, the tax person, have said, hey, book guys, wait a second, right? It's not as simple as just doing your book allocation over here. There's some tax baggage that comes along with this deal, right? And the book guys will not often understand this, at least is my experience. So you'll need to go through kind of a process of, well, why does the tax effects matter, right? And so far what we've said is, I have a deferred liability related to this equipment based upon what the book guys have done in terms of allocating purchase price. So the intangibles are the next piece, and you see this with deals around here all the time. The book guys will say, oh, the reason we bought this company is they've got some cool technology, so we're going to allocate the purchase price largely to intangibles, right? And for tax purposes, there may be no basis in those intangibles because all this company is like 8 guys sitting in a warehouse trying to create something, and there's no basis that they capitalize. They just expensed everything as R&D, right? So this is very common. And so that means if book basis is 1,000 and tax basis is 0, I mean, we have a big taxable temporary difference. That's going to create a large DTL. And again, the theory would be, well, look, if the day after this deal we sold our intangibles for book value, we would have a big tax gain. So we better accrue that gain now. We better accrue the tax effects of that. Otherwise, if we have that gain, we're going to have a huge tax provision problem. We need to anticipate that gain now because that's how deferred accounting works. Okay?
How does it work with, I've heard or I've seen where they have tax intangible. They'll say it was acquired, so it's not
Advertising.
amortizable, and it just sits there. It doesn't create a book. Yeah, I'm trying to see how that works in with.
Hang with me for a few minutes and maybe we'll come back to your question. Let me see if I can get to it somehow, because I'm not sure I know what it is. But in a lot of deals, there's no tax basis in intangibles. This example is very common. We'll come back to how the facts might change in a bit. So a lot of times a transaction will look like the buyer is inheriting a large deferred tax liability because books is saying the intangibles have a large basis, tax is saying they have none. So all of a sudden, it looks like we have this large deferred tax, right? This is very common. Okay. And now you see that for goodwill, books has called it 300. Books has said, hey, before knowing you tax guys were going to mess with this, we would say there was 300 of excess purchase price. There's no tax basis in goodwill. So there's a difference. But here you can see we haven't calculated a deferred tax liability on this. Okay? And that's because there's a special rule. And that rule says if you have book basis in goodwill that exceeds tax basis, you don't accrue a DTL. So some of you guys might remember on the exam, one of the questions was name 3 temporary items that you don't book a deferred tax for. This is one. So we have a difference of 300 in our basis, but we're not going to book a deferred tax, and it's because there's a special rule that tells you you don't need to. And now at least one of you is thinking, well, how am I supposed to know that because we're only covering this now and the exam was last week?
Yeah.
And the answer is that almost everyone misses that question. And I throw that question in just to stump the people who think they're really smart and think they get the whole exam right. So that question didn't affect you because I don't think anyone got it this time, right? You think? Got 3 reasons? Really? Okay, well I might have to find out who those guys are and then bust your guys' chocolate break. But anyways, know that there's a rule that basically says you don't book the DTL for goodwill. We'll come back to why in a bit. Okay.
What's that rule number? Like,
You know, I only remember the old FAS 109 rule. It used to be called paragraph 262. I don't have the ASC 740 site off the top of my head, but I think we touch on it in later slides. Okay. So now, we've said, hey, look, accounting guys, there's a 20 deferred liability for this truck. There's this big 400 deferred liability for this intangibles. We got to book these things. And so what you do is you take this deferred tax liability that you've quantified here, this 420, and you're going to book it as a DTL on your opening balance sheet. Remember, that didn't exist in the prior example. And by booking that DTL, the residual of your purchase price is going to flow up to goodwill, right? Because in order to balance your balance sheet, goodwill is basically your plug.
Sounds like booking taxes being
Well, at the end of the day, what you do from an accounting perspective is you stick on your balance sheet what you paid for the company plus the liabilities you assumed, and then you allocate that to the assets. And what the accounting guys did by starting before deferred taxes, they just kind of skipped over the step of, hey, we might have assumed some liabilities here. And what you as a tax person have told them is, hey, we do have liabilities. We got to put these on the balance sheet. And as a result, that changes goodwill in this example. In this example, this looks very common. I mean, this is a very common scenario. This happens all the time. So with the Novellus transaction, it's hard to see from the public data, but I guarantee you, for book purposes, they put up a lot of intangibles. You guys could see that from the 10K. The tax basis in those intangibles was way less than what the book's basis was, so they set up a deferred liability, and as a result, they booked a credit to deferred liability on the balance sheet, and they booked more goodwill as a result. Guarantee you that's what they did. How do you?
Is this ever structured so that it does change your tax basis?
It could, right? I mean, if this was a transaction where the tax basis was increased because it was structured as a taxable asset transaction, it would look like that. in which case book and tax is the same. There's really nothing to do. And that's an awesome answer. If you're a buyer, you're like, I got a future depreciation deduction. I don't have any exposure for these historical liabilities. I don't have any funky purchase accounting. I mean, this is a buyer's dream. The problem is the seller's not going to agree to it if they do the math. It's just not tax efficient from a seller's perspective, usually. Okay.
Isn't there also there's also the ability to negotiate between those two though? Like, they will all pay.
It depends. It depends who the buyer and seller are, right? If I'm an individual and I'm selling my stock to On, it is not negotiable to me whether I sell stock or assets, because I can compute my tax both ways, and I can show On that it's just mathematically she cannot pay me enough to get me whole for it to make sense for her. The tax rules will show that it is inefficient, and the only party that wins is the government. And so when we get the math on a piece of paper and we go through what the scenarios are, the most efficient answer for both parties will be to do a stock deal. And that doesn't bode well for On from a tax perspective, but economically she pays the least amount of money for my company as possible. Right? And taxes and everything. I mean, the buyer's going to look at the entire economics of the transaction.
I was just thinking as far as the perspective, like the liability that's out there might be something that might drive that, or it might be a premium somebody's willing to pay or not pay.
You know, everything has its price, right? Okay, so let's take a break. It's 7:15, so you can absorb that, and then that first hour is really just the setup of business combination accounting. That is the very basics of how this works. And now we're going to get into a bunch of like, well, what if that, or what if this, or what if that, and we're going to deal with specific instances that create twists and turns, okay?